All right, we're covering income from weekly put options. So at this point, what should you have at this point? Well, a brokerage account where you can sell cash secured put options. And what do I mean by cash secured put options? The money to buy 100 shares of the stock for each option sitting in your account. So we're not trying to sell put options without having the money. We're decreasing that risk footprint by having the money. Your chosen list of stocks for the weekly options. Enough money to purchase 200 shares of one stock. Why 200? Well, if a cash secured put option executes, then you have 100 shares. If you want a dollar cost average and buy more shares at different other prices to get a better average price, then you have the money to do that. Or if you want to sell another put option, then you would get another 100 shares at a different price. Either way, you get an average price that's lower than the current price of the stock. All right, exercise time. This is a long exercise. So pause through the next 3 slides to do the exercise. Take your time. In this particular portion of the exercise, let's evaluate which of your stocks are best for put options. Look at the below items, log into your account, and put in the stock symbol for one of your stocks. Again, you're picking a stock from your list. Open the options tab, chain tab, locate the put options information. So we're locating the put options information. Okay, the exercise continues. Now, like I say, take your time. There's a lot of information here, but take your time and go through and find this information in your particular brokerage account, in its interface. We're looking at put option variables. So notice the put options table. It shows the dates, the bid prices, the ask prices, the strike prices for different options. You need to decide what you're willing to pay for 100 shares of the stock. So these are cash secured put options we're talking about. You have the money to buy 100 shares of the stock. The goal is to examine these put options at different strike prices to see also the bid price at different strike prices, to see if the bid price and ask prices are prices that are closer together, and can you make money by selling the cash secured put option for the bid price? Is that bid price high enough? Is that a good bid price for you? And out of the money, strike price for the put option is going to be lower than the current value of the stock. So if the current value of the stock, for example, was $10, and out of the money, strike price would be maybe a $9 put option. So just like the call options, the bid and ask prices are what you're actually looking at. But in this case, we're looking at put options. So keep in mind that the closer the strike price is to the current price, the higher the bid price would be, and the more the likelihood of that particular option selling out. So pay close attention to these items and go through them. Take your time, go through and find them in your interface, in your brokerage account, because the objective is not for me to say, here's exactly how it works in your account. The objective is for you to learn how to actually navigate and execute trades and make decisions independent of this course. When this course is over, we want you to be able to go in and say, oh, okay, bid ask price, I know the difference. Strike prices, in the money, out of the money, I know the difference. So continue to look very carefully for these particular items and these concepts and understand. Exercise continues. Now, take a look at that list of stock picks. You know, the list that we talked about a while back earlier in the course. You're looking for the best bid price for whichever option you choose to sell. The best bid price for that option. And that's going to be the stock that you're willing to buy 100 shares of, but you want to be able to make money by selling that put option for the highest bid price relative to the strike price. So if the strike price is at a level below the current price and the bid price is of value, and that's enough value worth selling that put option, then that is the particular put option you want to sell. So now we're getting to the end of the exercise. So take a look at that statement and analyze that and restart the course. Okay. Now we want to go into another portion of the course that involves actually how we're buying different shares, the number of shares we're buying now. The shares of the stock can be bought, you know, with a put option, obviously 100 shares at a time. And that can happen on weakness. Let's say the stock market is having a down day. On that down day, you could actually have those shares put to you where you actually buy 100 shares of that particular stock. So that's how you can get it at a discount. So the next example, we will show XYZ stock at $22. And we will talk about if you sell the $22 put option, you will be buying 100 shares of that particular stock. And that's the example we're going to cover a little more in detail. Now, here is a put option example where you can see how XYZ company has different price points: $10, $30, $22, $28. Now, here's a put option example where if you sold the $22 put option, if that goes down to $22 or beyond within that period of time, you will buy 100 shares of that stock at $22 a share. And that's where you see the 100 times 22 equals $2,200. Now, with put options, you can do dollar cost averaging also. Here's a dollar cost average example where you're buying 200 shares of XYZ company. Now notice that the put options are at different strike prices. One of the strike prices here is for the $22 strike price, and one is for the $28 strike price. So with put options, again, that's why you need to have enough money in your account to buy 200 shares of your chosen stock, because you can dollar cost average with put options where you have obligated yourself to buy the stock at two separate prices. For example, the 100 times $22, that's $2,200. That if the first put option executes, that's at $22. And let's say the second put option executes at 28, 100 times 28, that's $2,800. And if you add those two instances up, you have an average price. So you're dollar cost averaging with put options. So 2,200 plus 2,800 divided by 200, because remember that each option is 100 shares. Now we have an average price per share of $25 per share. So this is a very good example of literally dollar cost averaging selling put options. As we continue, now you're looking for a stock from your list in general where the bid price is out of the money and that bid price has value. Now, what I've learned in my experiences, if you look very closely, you'll notice there are certain stock options where the bid price is way different than the ask price by huge percentages. So if you look at the different stock options where the prices are kind of close together, that seems to give a better opportunity for you to make money. Those particular options, and every option is not the same. So some options are not as lucrative as others. So we're going to look at the $22 strike price for the May 15th put option in this example. And we're going to assume a current market price of $24. So take a look at the table, get familiar with the values in the table. Notice where the out of the money options are located, the strike prices are located. Okay, let's look at an example now that you've gotten familiar with how the representation of the tables for the different options can show up in your account, and you see the different values. Now, let's look at for the $22 put option. Now, in this particular example, we have an ask price of 25 cents. We have a bid price of 15 cents. If you sell this put option for the 15-cent bid price, you get $15 per contract for each 100 shares. So if this put option expires in this particular case, May the 15th, 2020, above, because we're talking about put options. So if it expires above $22, the $22 strike price, you get $15 for that week. We're talking about weekly options. And keep in mind that in your account, you have the money to buy 100 shares of that stock at $22 a share. So you have $2,200 reserved in your account. Now, if you divide $15 by the $2,200, you get 0.0068. Multiply that times 100, and for that week, for that option, 0.68% return minus any other fees. So 0.68% return for that 1 week, which still, if you look at that, that is for that 1 week. That is a pretty good return. So this is just showing an example of how you can make a decent return depending on if you select a put option to sell that has enough value with the bid price. Okay, we have an example. This is an example of if the put option that you sold, in this particular case, May the 15th, is exercised, meaning the buyer of the put option decides to sell you the shares of the stock for $22 because the stock either went down to $22 or beyond that within that time period. So the stocks are put to you at $22 a share. So you are obligated to buy those 100 shares. So in this example, you actually have the $15 you received for selling the put option at the bid price of 15 cents a share. You had $22 a share times 100 in your account to actually have the cash secured put option implemented. So let's go through the math. So 15 divided by 2200, 0.0068 times 100. So 0.68% return minus fees. But in this particular case, if we go ahead and we put in the amount you spent and subtract the credit you received for the $15 put option, you spent $22 times 100, $2,200 minus $15 plus fees. So you effectively have spent less than the $2,200 by subtracting the credit. But at this point, understand that this is what will happen if the shares are put to you, and you need to be happy to receive the shares at a discount. So this idea of selling cash secured put options is based on you selecting a very good stock, not a diamond in a rough, but a diamond. You want the top of the line stock in that industry. Okay, exercise time. Now, pause the course and look in your account and try to identify the items in your brokerage account that's similar to the items here listed. So now, in this example, we're assuming that you have the money. This is for a put option. You have the money to purchase 100 shares of the stock of choice. And this will be one of the stocks from the list, from the previous training exercises of filtering and getting stocks that are actually high quality stocks. Now, so log into your brokerage account. Now, this is not a race. Take your time. Pick the stock symbol, click on the options tab, and find an out of the money put option you want to sell. Now, you want to select a bid price that is lucrative enough for you to make money. Now that bid price, as you look through the list of different strike prices for the put option, needs to be high enough where if you sold it for that week's option, you actually could get an okay return. Now select the bid price for the put option you want to sell for the date desired. Now this is an example. You don't have to really go all the way through with this, but look around. You don't have to put this configuration actually in and actually execute it, but look at what you would do if you were to execute it. So in the example, look at the example here, stock symbol XYZ. In this case, the date of the option, May the 15th, 2020 in this example. So we're trying to sell the $22 strike price put option. The type of option is put. Notice the action says sell to open. We're opening this position up. For one contract, the quantity is 1. We want to put it in a limit order. So we want to either sell it for the limit price, the bid price of 15 cents or higher. That's what the limit allows. And the timing, how long do we want this position to be in place? In this case, I'm saying good until cancel. So if the conditions are met within the time limit of this option, it can execute. So slow down, take a look. This is not to be executed necessarily. This is just an example. So look around in your account to try to find where these particular variables would be. If you were to sell a cash secured put option for a stock in which you have the money to purchase 100 shares. Okay, as the example continues. Now, assuming that you sold the put option for your stock of choice. Now, if the strike price of that put option is not reached, in this case, May the 15th, 2020, before on May 15th, here's an example of how you buy the option back. You clear the obligation for you to satisfy the put options requirements. So by buying it back, you are giving yourself an opportunity to sell another put option if you choose to do so. Now, if you don't buy it back and the option does not reach the criteria within the time limit, in this case, if the stock doesn't go down to $22 or below within the time limit, May the 15th, the option will expire worthless and it automatically will clear by the next trading day. In this case, if it expires on Friday, by Monday, the position will have itself already cleared completely out. Now, this order example shows how if you wanted to buy the option back and clear the position out before it expires on the expiration date, and you even could do this before the expiration date, but let's go through the example. So stock XYZ, you want to put in for the date the option that you already have. So you want to pick that option. The strike price, in our case, we sold the $22 put option. Type of option is obviously put. The action here is buy to close. We're closing this position, so we're buying to close. Since it's one option, quantity is one, the limit. Now, on occasion, not necessarily every time, it's possible to buy the option back for 1 cent per share on expiration date. Now, it may be 2 cents, it may be 3, but you're buying it back for the ask price. So if you were able to buy it back for the ask price, in this case, it would be $1 to close out this particular option obligation, to buy it back. And I say good until canceled. So this is an example of how to clear it out. For example, if you wanted to clear it out earlier during the week, or Wednesday or Thursday, whatever the ask price is, to buy it back to close, you buy it back at the ask price. All right, we're going to end the exercise and restart the course. After you've taken a look, take your time. This is not meant for you to execute. This is meant for you to review. Okay. Okay. Remember when we were talking about put options, this is a very, very, very important concept here. We talked about making sure if you are going to sell cash secured put options that there's a high quality stock that's being chosen for that. Now, you have risks associated with the stock going down beyond the strike price at which you sold the put option. So, but to protect yourself, you can actually purchase a put option beyond lower than the strike price of the put option for which you sold. So So if you want to buy protection to protect yourself, for example, if you sold a put option, you sold a $22 strike price put option, and you want to protect from downward risk from that stock going beyond, for example, $20, the $20 strike price, you could actually purchase the $20 put option to protect the value of the stock from going down further. So if that stock was put to you at $22 and it went down to, let's say, $18, if you wanted to protect the downward risk by purchasing a put option at $20, you would have that protection where you could later sell your stock at $20 if you chose to do so. But you give up some of your profit by purchasing that $20 strike price put option, but that is protection you could put in place by giving up some of your profit. So let's go through this example very carefully. So if you want to buy protection from your stock's price falling far beyond the put strike price that you sold, you can buy a put option at a lower strike price to protect against your downside risk. So in this case, look at the $20 strike put ask price. So in this, it's showing that you would pay the ask price of 5 cents a share to buy the $20 strike price put option. So take a look at this, get familiar with this, and let's continue on. Now, assuming that you sold the $22 put option, you could, again, you can buy protection. You can put in protection, protective put option. So the put option, the $22 strike price could be reached before or on May the 15th in our example, 2020. Here's how to buy a put option to protect the downside risk beyond the $20 strike price, as we talked about earlier. So this is an example of a protective put order. Now, what we're doing is we're buying a put option. So for whichever the stock is, XYZ stock, May the 15th, 2020, we're buying the $20 strike put option because we want to protect against the value of the stock going down beyond $20 if the option is assigned to us. So the type is a put. Buy to open, we're buying to open one contract per 100 shares. The limit price, we want to buy it for 5 cents. In this particular case, the ask price of 5 cents or less, or whatever the ask price is. In this particular case, since we put in 5 cents, it will buy it for 5 cents or less. Now, if the ask price is higher, we put in a higher ask price. Good until canceled. Now, the key thing too is to make sure this particular order executes. If this order does not execute, you do not have that protection. So it's critical that if you want the protection, that this order actually executes. So you need to ensure that this order executes to have that insurance. So pay close attention to this, because this is helping mitigate risk of selling cash secured put options. What you're doing is you're protecting yourself from the stock going down further, but you have to give up some of the profit to do that. In this particular case, 5 cents a share. Let's move on. Okay, from the previous example, if you sold the $22 put option for $15, which is 15 cents a share, and you bought the $20 put option for 5 cents a share, for $5, then you spent $5 extra to actually protect yourself from downward risk because you sold the $22 put option. You now have protection beyond $20. So in this case, you would get the $15 that you received for selling the $22 put option minus the $5 you spent buying a put option for protection for downward risk. So in this case, for this particular week, for this example, you would have $10 divided by 2,200 because the $2,200, that's for $22 a share times 100 that you would have in your account. If that stock went down to $22 or less, then you would be able to buy the shares for $22. You are obligated to buy those shares for $22 a share. So in this case, $10 divided by 2,200 equals 0.0045 and times 100. That's 0.45% return minus fees. So in this case, you would make less money, but you have protection. So this is the protection I was talking about earlier, that you can actually control how far the stock goes down and what your limit is as far as paying. So if the stock went down, for example, to $18, you could actually exercise the put that you bought and sell the stock for $20 a share. So this is just an example of how you can insure yourself against massive losses. But the idea is to buy very, very good stocks. Buy the top of the line stock in the industry. You're buying a diamond, not a diamond in the rough. Okay, to continue, assuming that you've sold the $22 cash secured put option. Now, look at this example. Now, if the $22 put option that you sold is exercised because the stock went down, let's say the stock went down to $18, which is below the $22 strike price. So you spent $22 because let's say that put option is exercised. You spent $22 per share times 100, so $2,200 to buy those shares. Now, since you bought, in this case, the $20 put option, you have protection beyond the stock going down beyond $20. So you could, in this case, exercise your option and sell the stocks for $20 a share, since you bought the $20 put option as protection, downward protection. For this case, where the stock went down to $18, and the owner of the put option exercised their option and sold you the shares for $22, because that is part of the agreement. When you sell cash secured put options, you're obligated to buy the shares at the strike price. So let's continue on. So now that you have the $20 put option, you could exercise your put option and actually sell those stocks for $20 a share if you chose to do so. Now, in this case, if you did that, you would limit your loss to $2 a share. But since you actually got $10, as we did in the previous part of this example, for selling the $22 put option, the net amount of selling the $22 put option and subtracting the $5 you spent for buying the $20 put option, which is $10, you would normally would have lost $2 a share, but it's $2 times 100, that's $200 minus the $10 credit. So your loss would be $190, not $200, which would be the difference between the $20 put option and the $22 put option. Now, also another situation could be taken advantage of is also now, since you bought the $20 put option, that $20 put option gets value as the stock goes down. So you could just sell your $20 put option to offset losses. So you have some opportunities to make some choices if you buy insurance on the put options you sell. However, you just have less profit. So just keep in mind there are trade-offs. If you pick very, very, very good stocks and you're very confident with those stocks, you can decide whether it's worth buying put options below the strike prices for the options you've sold. So you have to make a decision there. You don't have to buy put options beyond the put options you sold, but that is something you could take advantage of extra protection just by giving up some of the profit. So I wanted to cover that to be sure that you know of a way to mitigate some of the risk associated with selling put options.